Hello and welcome to an AllGen market update. My name is Jason Martin. Today is September 28th, 2022, and just wanted to take a moment to update everyone on the market. It's been a pretty difficult year this year and wanted to share kind of our thoughts, what we're doing, address everyone's concerns. So let's take a look at the agenda. So first we're going to look at inflation. And, because inflation has been so high, what the Federal Reserve has been doing about that, and how they've been raising interest rates so aggressively. We'll look at the effects on the bond market and potentially what is next or what's coming in the bond market, and then how AllGen is managing risk. But also I want to touch at the end on how it's important for our clients and everyone who watches this video to be prepared for financial storms. And I say that as I'm in Orlando, Florida, and Hurricane Ian is headed our way right now. As you can probably see, it's back right of my shoulder, raining and windy outside. So just wanted to touch on that, as not only do we have big hurricanes coming, but we also, potentially could have a financial storm, and maybe we're already in the middle of one. And so it's important that everyone is prepared for that. So let's hop right in and take a look at this first chart here. Looking at inflation, you can see the purple line is the U.S. inflation rate, the main U.S. inflation rate, and then the orange line is core inflation, which backs out food and energy, which can be a little bit more volatile. So you can see it looks like, and we'll see if this ends up being the peak, but July may have been the peak in the U.S. inflation rate. However, it wasn't the peak in core inflation. As you can see here on this next slide, while energy came down some, and that was a big part of why the main inflation rate came down from 9.1 to 8.3. You can see right here, energy became a smaller amount of this overall category. However, the one that has caused a lot more inflation, especially the core inflation rate, is shelter, or basically housing inflation, rent and mortgages going up. And that makes up or constitutes about 40% of CPI. So it's really important to watch that one. That one tends to be a little stickier. So inflation is still sticking around in general, and the core inflation has risen. So with that, the Federal Reserve has gotten even more aggressive at raising interest rates. So we can see here is a chart that shows kind of the federal funds rate, and this is where we are right now at about 3.13%. After the Fed raised rates 75 basis points last time they met. Most likely we will be somewhere close to 4.25 by the end of the year. But what I want to focus on here is what it looks like is going to happen over the next year and 2 years. You can see the dark blue line is what the Federal Open Market Committee, or the Federal Reserve, is kind of predicting. That's their estimates, so that if we got up to like 4.25 by the end of this year, and then we're at 4.6 at the end of next year, or actually at the start of 2024, end of 2023, then it looks like it should fall after that. Now, the market expectations think we're going to peak sooner at around 4.27% and start to go down from there. But in both expectations, that looks like it looks like interest rates will go up in the short term, but then start to turn and go lower. So it's important to know that, because it's not always what the Federal Reserve is doing right now. Obviously, they've raised rates very aggressively, but it's more important to know, or just have a good idea of what's going to happen in the future, because markets are forward-looking, and they try to price in, or what's called discount, what's going to happen in the future. So if the Fed continues to raise rates in the short term, but then lowers rates, maybe bonds could be reaching a turning point. So as we look at bonds, there's a chart I've been showing often, and we're just in an unprecedented year with bonds. Bonds have gone down the most ever on record for a calendar year, especially through the first 9 months and even through the first half of the year. And this chart right here looks at just the last almost 50 years, 45 years. And the red dots down here are the intra-year low. The gray bars are where you actually finish the year. So you can see some of the worst years, intra-year, you were down 7 over here, you were down 9, you were down 7. Well, this year we're down 15. And that's actually where we're at right now. So almost double what the worst year was. But I also look at that because even in some of these years, where you were down big, the bond market actually ended up positive those years. And in the years where the bond market did end up negative, like this year and this year, the following years were very strong. So even over here, down here, and up again right here. So it's important to know that, because if the bond market has had such a rough year this year, and actually had a negative year last year as well, then there is a high probability that it will bounce. And so let's look at one more chart though that kind of shows. That was looking at the aggregate bond benchmark, which is U.S. government bonds, corporate bonds, a mixture of all types of bonds. This particular chart here on the left is looking at just U.S. 10-year U.S. government bonds going back to 1928, so going back a little further. And what were the worst returns since, over the last almost 100 years? And the red numbers here show you the worst returns each year, and then the green bars show you the subsequent year and what they did that next year. And you can see every of the worst 7 years in the last almost 100 years, how large the returns were the following year. And so I say all that to say, even though bonds have had such a bad year, and really because bonds have had such a bad year, what that means is as bond prices go down, interest rates go up. So you can see here, like a 10-year U.S. government bond right now is yielding nearly 4%. And that's the highest yield in 12 years. AAA corporate bonds are yielding almost 5%, and that's their highest yield in 13 years. So bottom line, there's a very high probability that bonds will make a strong bounce. And they also, because yields are much higher, they almost double and triple, actually almost triple what they were a year ago. Now, at least if you're getting into bonds now, if you're adding into bonds now, like we're starting to add more into bonds right now, you're getting yields much higher. So even if the price of the bond goes down a little bit going forward, you're getting a much higher yield. So that really lowers the risk of bonds going forward and presents what we believe is a really good opportunity in bonds. So I also wanted to kind of just put things in perspective. Switching to the stock market from the bond market, this is looking at the S&P 500. It peaked in January of this year, beginning of the year, at 47.97. And as of today, or yesterday's close, it was down 33.4, or excuse me, it was down about 24%. But if we look going forward, okay, so that already happened. If we look going forward, if the market got back to where it was at the beginning of this year, it got back to its peak in 1 year's time frame, the market would go up. The S&P 500 would go up 33.4%. If it took 2 years to get back to that market peak, then the S&P 500 or stocks in general would average a 16.5% return. And even if it took 3 years to get back to that peak, the S&P would average 11.4%. So, and as you can see, even 4 and 5 years, it would still have a decent average going forward just to get back to the peak. I say that because, it's when you're investing, you have to look forward. And so what are we going to do going forward, and what are the potential returns going forward, as opposed to what happened in the past? And it's tempting when markets are down, especially bond markets are down and stock markets are down, your portfolio's down, to think, oh, we need to go cash because we need to stop the bleeding. Well, if you do that, you can miss out on very large potential returns. And that's usually where the biggest mistakes happen, is when people get scared and they sell towards the bottom. That being said, it's important for everyone to know that we are managing risk, and we have been doing things in your portfolio even at the beginning of the year, as we went into this year, that really helped reduce the losses. So let me talk about that. So going into the year, we were very underweight, and we sold one of the hardest hit areas prior to the year start. So we sold a lot of our large U.S. growth stocks, which were the most expensive, and now they're down. Most of them are down 30% on average. So we got out of that. We overweighted value stocks. So when we moved from growth to value, increasing value, and not only value stocks, but value stocks with very solid balance sheets and good cash flow. So that is down half as much as what, or that area is down half as much as what the U.S. growth has done. And so that has protected your account. It's still down. I mean, if that area is down around 15%, it's still a pretty rough year, but it's not down 30%, which would have been really, really bad. So we also underweighted bonds. I just was looking at a chart and saw that bonds are actually down slightly more than dividend stocks, so the kind of value dividend stocks for the year, which is incredible to me. Both of them are down around 15%. But we were underweight bonds. We saw interest rates going up. We saw the potential weakness in bonds. So we were underweight bonds, and we were focused on less interest rate sensitive bonds. And we were overweight commodities with inflation. And that was the only asset class for the first half of the year that went up. The main asset class was commodities. Over the past few months, we've started adding to bonds as we see some great potential opportunities there. And we've also added to high yielding money markets. The benefit of interest rates going up is now our money markets are yielding close to 3%, and which that'll probably get closer to 3.5%, 4% by the end of the year. So increasing some of the bonds that we see opportunities, but at the same time, just in case bonds get worse or stocks get worse, having those high yielding money markets help. And a lot of our portfolios have close to 10% in that kind of short-term cash fixed income yielding close to 3%. So that is a protective measure. And then we've continued to reduce stocks as as we put more money into bonds, put more money into those safer assets. We've reduced stocks over the past few months. We've also reduced commodities. Commodities had a big run at the beginning of the year. Now they're starting to come down. And so we've used some of those commodities to buy or sell some of them to buy some more bonds and buy some more safer high-yielding money markets. Going forward, we plan on maintaining a defensive position, but we also need to be ready in case stocks take a bigger hit or some really good opportunities arise, whether it be bonds or stocks, and be ready to deploy some of that cash or deploy some of the bonds that initially went up into stocks that may go down. So that's our update. But before we go, I wanted to touch on a piece that's really important, is how to be prepared personally in your finances for a financial storm. And if you've been around AllGen long enough, you've seen our path to financial freedom. What I want to focus in on is the foundation section, which is kind of how we help people get prepared for financial storms and to build wealth. And so, if you're going into a financial storm and you have a very solid emergency fund, 3 to 6 months of emergency reserves, in some cases, for those who are retired, close to a year's worth of expenses set aside in just a savings account that's there for you when you need, in case you lose your job or in case you need to replace a roof. You don't have to pull from your investments when they're down. You have those emergency reserves. Obviously having the proper health insurance, life insurance, disability, and having a will in place is important. But what's super important is being completely consumer debt free. If you can minimize your expenses by not having to make car payments and student loan payments and credit card payments, and all those payments that are increasing your expenses and decreasing your net cash flow, that puts you in a position where you're taking less risk. If you don't have any consumer debt and you're not having to make all those payments, you have less expenses. If something bad was to happen, you can go a lot longer with those emergency reserves than if you're deeply in debt. So super important to be consumer debt free. And then for those who, further on as we get out of our foundation, have that in place as we're getting into trying to prepare to be completely financially free, being completely debt free, mortgage and all, even if you own a business, no debt in the business. If you're in that position where you're completely debt free, it helps you get through difficult financial storms. So I just wanted to share all this with you to help you guys feel better, to know what we're doing. And, we just hope and pray that everyone stays safe for this Hurricane Ian. Thank you.